Well, hello, everyone, and welcome to the first quarter 2021 Focus on the Market series. I'm Karam, Chief Investment Officer with Finspire. Looking forward to turning the page from 2020 and into 2021. And we've got a good wrap up here for you. What we think is a good summary of what happened in 2020 from a markets and economy perspective, and give you some thoughts about what we're looking forward to in the year 2021 and beyond. First, we need to start with a little bit of levity. All right, we went into this year very positively, and then of course COVID struck, and it struck not just our health, but it also struck our money. And the visual that we shouldn't forget, March 16th of 2020, where we saw the Dow Jones Industrial Average lose 3,000 points in a day. We saw the S&P 500 lose 325 points in a day. Really extraordinary figures, and we entered a period of extraordinary volatility as we really jumped into the unknown as it relates to COVID-19. Of course, things progressed. Things got better from a markets and economy perspective throughout the year after the depths of what occurred in the first quarter. But even Santa Claus couldn't escape the needs for contact tracing, just like we all do today. 2020 lost a special saxophonist. His name is Alto Reed. He is famous for his saxophone riff in Bob Seger's Silver Bullet Band, especially the one you all know as from Turn the Page. So we're going to turn the page on 2021 to 2021 by giving you a little bit of perspective of just what just happened in 2020. In particular, the economy went through its wild swing, right? Unemployment went from a very impressive 3.5% ballooned all the way to 14.7% before finishing the year at 6.7%. And it really introduced this whole concept of pandemic stocks and stay-at-home stocks. Things like Tesla, for example, which benefited greatly from increased retail sales, increased auto sales, a strong consumer. Tesla grew so much in value in 2020, it equaled the approximate value of BMW, Mercedes, Volkswagen, Fiat, Chrysler, Ferrari, Honda, Toyota, Subaru, Mazda, Mitsubishi, Ford, and GM combined. It's really an extraordinary story. And that's aside from the FanMag stocks, Facebook, Amazon, Netflix, Microsoft, Apple, Google, that did exceedingly well as people stayed at home more and had home offices built throughout 2020. 2020 obviously was full of challenges, brand names, large brand names, value recognized names like Brooks Brothers, Neiman Marcus, JCPenney, California Pizza Kitchen, Hertz Rental Car, all went through challenging bankruptcies in 2020 as the world changed, right? Stopped traveling, stopped dining out, et cetera. And with that, there was a government response, right? Congress experienced in the fiscal year end, September 30th, 2020, a budget deficit of nearly $3 trillion, or actually over $3 trillion. We'll talk more about that in a moment. The election notwithstanding, we did have a significant medical miracle towards the end of 2020, as we now have both the Pfizer and Moderna COVID-19 vaccines being circulated, not just here in the US, but around the world, so that we can repair medically and from a healthcare perspective from COVID-19. So by the numbers, if you look at the markets themselves, we had a huge surge in emerging market stocks and small cap equities here in the US in the fourth quarter of 2020. So much so that emerging markets actually outpaced that of the S&P 500, large company US stocks, which it didn't look like it was going to be the case through the first 3 quarters of the year. International stocks also surged plus 8%. Developed non-US stocks surged 8.3% in 2020 after being negative for the first 9 months of the year. And fixed income. Owning core fixed income in 2020 was a huge value add to portfolios, especially during those very volatile times of the first 3 quarters of the year. And you can see high quality investment grade fixed income finished at plus 7.5% in 2020. Commodity prices actually got off the mat. They were significantly negative at the end of the third quarter and finished just slightly negative on the year. but we did see commodity prices rebound as the economy and markets themselves rebounded. And we got a hint of inflation, which we'll talk about in a moment. As you might imagine, leading economic indicators are trending in the right direction. After experiencing a sharp drawdown, we saw a sharp rebound, and we're clearly in economic recovery mode and growth mode, but it's very uneven. Why it's uneven is primarily, the rebound was primarily driven by a strong U.S. consumer. Consumption by U.S. citizens accounts for approximately 2/3 to 70% of economic growth. You can see just by this metric of retail sales, whether it's in-store or e-commerce in the in-store in blue and e-commerce in the other line, you can see that e-commerce, as you might expect, up nearly 30% year-over-year change in e-commerce sales, which really helped pull the economy along during a very challenging time. And with that, the equity markets continued their recovery. So notwithstanding a huge drawdown, which we occurred in the first quarter of 2020, you can see when you look at the big picture, equity markets measured by the S&P 500 since the financial crisis bottom of March 9 of 2009 really finished nearly its 13th year of positive bull market territory. As we restarted a bull market in April, we saw that the S&P closed the year at 3756. Pretty extraordinary run over the past 11 years, where we've seen that index grow 455%. Why is that important? You might give people some perspective about the long-term results they've had in their portfolio. It could also impact what people do from a tax loss harvesting area, as we may see different tax policies with changeovers from the recent election. All right, we wanted to show you the COVID-19 charts because that's still having a huge impact on our economy, namely employment. You can see global cases, US cases, state of New York specifically, which was particularly hard hit during the COVID-19 crisis. Those cases are on the rise. And however, what we have seen is a precipitous decline in the death rate, and not only with the new vaccines, but also with the advances in the medical therapies that are being applied to treat COVID-19 patients. The death rate is coming down, which is good. However, we are seeing in the last payroll report, we saw in December, we lost 140,000 jobs. Most all of that was attributable to the restaurant closures and the jobs lost from COVID-19 sensitive sectors being shut down once again in various states across the country. So as we look ahead to 2021, we want to see this improve, and we think it will as more people get vaccinated and as more people return to quote unquote normal ways of living. From a earnings perspective, the S&P 500 sector saw a pretty extraordinary decline, as you might expect, in overall corporate earnings. However, looking forward to 2021, the way markets are priced in today, they are expecting a significant double-digit rebound positive in earnings expectations going in throughout the course of to unfold throughout the course of 2021, even in very sensitive COVID-19 sectors such as the energy sector. So we'll see how that plays out. Global central banks and Congress here in the US and actually legislatures all around the world really jumped in with substantial capital markets liquidity and relief measures. The Federal Reserve's balance sheet, you can see here, went like a straight line higher in 2020 to a balance sheet of $7.3 trillion, which is really extraordinary. The amount of liquidity that was injected in the first quarter of the year was critical to getting equity markets off their bottom, and it was also critical to getting the economy to find its floor and footing as it progressed throughout 2020. The federal budget deficit, after their relief measures and stimulus measures through multiple legislative actions, resulted in a fiscal year September 30th, 2020 fiscal year end deficit of over $3 trillion. And that is something now, when you add those $3 trillion to the already substantially sized national debt, it is starting to have an impact on, we think, on the capital markets and the financial markets themselves. As you can see here, total debt and net debt have both exceeded or are near or above 100% of GDP. And when you get to those levels, you do start to see certain areas of the capital markets have an impact, namely first, the US dollar. So the dollar, which has been very appreciative over the last 10 or 12 years, has hit a near-term decline here. And we think those trends, if we continue to see large deficits and a growth of debt relative to GDP, you could see the dollar decline further relative to other currencies globally. And what that does, however, is create an interesting opportunity for us as US investors to invest overseas as other currencies strengthen relative to the US dollar. Inflation throughout all this, however, has remained low. And this is one of the stories that we're watching throughout 2021 because real yields on US Treasuries after you account for inflation are currently negative. And the Federal Reserve has indicated that they're going to allow inflation to rise above its 2% target for a period of time for the purpose of experiencing further economic growth and further jobs growth. So this is something that we're watching very closely. And this recent little spike upwards in core inflation is something that could have an impact on the way portfolios are managed and reallocated throughout the year. Because of that, because of that scenario, we think we have seen a bump higher in the yield curve from a quarter ago. So the blue line going right through the middle is where the yield curve was as of January 12th. And relative to that 3 months ago, which is that pink line at the bottom. So you can see that the yield curve has actually bumped up higher. The 10-year Treasury 3 months ago was at 0.81% versus being at 1.15% today. The 30-year Treasury at 1.6 to 3 months ago to 1.88 as it stands today. And all of this, of course, being anchored by short-term rates, which rest at zero. And the Federal Reserve has indicated they probably will not touch that for another couple years or move that rate off of its zero line for the next couple years. So that's the impact that we're seeing of potential increases in inflation are having not only in real yields, but also in the overall Treasury yield curve. And it's a story that we're going to see develop throughout 2021 and measure whether or not a change in portfolios needs to be made or an adjustment should be made based on those indicators. So as always, today we appreciate you joining us. We're sharing not just facts and figures, but also our opinions. We look forward to sharing our thoughts with you both virtually and digitally here in the first quarter, but also hopefully later this year, we'll be able to get to see you in person. Thanks so much for watching and tuning in today, and we'll talk to you soon.